Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Okay. Hey everybody, good afternoon. This is David Blake, and this is our Tuesday Tech Talk. And today we're going to just quickly review what's going on the last couple of days. We'll look at what kind of technical damage we've done to the market. We'll also look at a couple of different indexes, look at some of the support and resistance areas. We're also going to take a special look today at what can happen to the market and what asset classes can outperform or you should have some exposure to if the dollar weakens in here due to cut off and raising rates for a little bit. So at the end of this thing, we open it up. I talk for about 20, 25 minutes, then we try to open it up to questions. Anything you want to talk about individual stocks or questions about what we just spoke about, we'll go over. All right, well, since last week, had kind of a rough Friday. We were talking, we've been kind of looking for a counter trend rally. We've had a little bit of one. But last Friday, kind of the lukewarm jobs report kind of sparked off a sell-off. It took the NASDAQ and Russell down to levels from 2014. It was strange because the unemployment rate fell to 4.9% on the soft jobs report, and the 10-year yield actually fell down to 1.8%. I think it's down to about 1.7 today, maybe a little bit under that. And just at the start of the year, we were looking at 2.4%. As we began what we thought was going to be a series of interest rate hikes. Now someone started a rumor that the March rate hike would still be on the table after that jobs report, and that's what kind of sent the market down. Oil prices backed off again. The U.S. dollar eased. So then we had so what we're looking at right in here is what if the dollar is going to back off, and it's down again today. Down about another 0.5%. We're trading about 24.87. What will what sectors and maybe what industries and other asset classes we can look to put in our portfolios to kind of protect ourselves to the downside. Okay, there's a couple of things going on this week before we get to the charts. That's beginning tomorrow. Fed Chairperson Yellen is going to give testimony before Congress, kind of update everyone what she thinks they'll be doing with rates going forward. At this point, I think the CMOE FedWatch has the chance of a March rate hike at about 8 or 10%. So it doesn't look like we're going to be doing anything at that point. But anyway, that's because of that. That is putting additional downward pressure on the U.S. dollar, which got a little bit stretched here. And what we're going to look at right now is whether we're looking at possibly another double bottom in this market, or something that's a little bit more troubling to me, and that is a technical pattern called a chart pattern, or of a flag pattern that I've noticed on all the different charts, and actually kind of started to take it out yesterday and today. Okay, chart number one. This is the chart. This shows the flag pattern over here. What the flag pattern is you have a line down or a line up. They call this the pull. And then you have a flag branching off. And normally what happens is you'll have a resumption of the pull going out the other way, whatever way it usually came in. And the way you can look at this is if you measure from here, up here around 17, right around 17.6, go down to the bottom of right here where we started the flag pattern over here, you have about 1,800 points. Okay, now you come up to the flag over here where we start the descension right in here. And that puts about 16,500 as the top of the flag, and that's going to put a downside target of 14.7 for the Dow Jones if we break through here. And it looks, again, today we're trading down in here. The Dow, as we speak, is off about 70 points. We were down 150 earlier, trying to hold around the 16,000 area, and right now we're at 15,957. So we're struggling in here, but a good clean break is going to, again, target 14.7 on the Dow Jones. I think a best case scenario is you come in here and maybe you get a 15,450 try to hold for a double bottom going back to the September break. But that doesn't look real good to me. Now, going out over on a weekly chart, going back to 2009 on this whole bull run, you can draw up here, get a couple bounces off this trend line. You broke it in August, came back up, had another dead cat bounce here, and we broke that again back here, right about mid-January. We've come up to where the trend line goes. Now we're rolling over, and we're hanging on tooth and nail just to try to hold on to that 200-week moving average. And you want to kind of keep an eye on this chart, because if it breaks down below that 200-week moving average, that's going to be kind of another kiss of death with the golden triangle or golden cross and all that, or death cross, I'm sorry, and some of these other things that are negatively happening. Here's the S&P 500. Again, we have the same flag pattern coming on here. Top of the flag is about 1940. Down to here, you take this, go up here about 1940, take that away. You have about 185 points lower, and you're going to come to about a target on the S&P 500 of about 1755, 1750, that area. Okay, the S&P 500 broke the flag pattern yesterday, as you can see. Dow Jones crawled back into it, but the S&P 500 didn't. And of course, we're down today a little bit also. So that's going to give you a target. If we don't match bounce off right in here, I think you're pretty much advised we're going to have that bear market going into it. Now here's the longer term trend line on the S&P 500. You've been able to bounce off that. Got a little overstretched here, and we're right down here bouncing off this long-term trend line on the S&P 500, which also coincides with the 200-week moving average. So again, we're really at a crossroads on the S&P 500 as far as whether or not we're going to be able to hold this. We're certainly susceptible to getting some counter trend rallies in here, which you normally will have a couple of them before you go into a bear market. But this is the area, especially this 1810, 1800 area, that you really want to watch closely in here. Okay, the NASDAQ, it broke out of its flag pattern actually last Friday. And unfortunately, it continued sharply lower again on Monday, took out the low in August, September. And that doesn't really bode well going forward. Now up here at the top here, we have about a 5110, where the pull starts over on here. Come down the pull to about 4,400. That's going to be 710 points, 4,650. Here's the top of the pull. Your target on the NASDAQ is going to be about 3,940, which would be right around this area. That'll take you back to about November 2013. All right. Now, if you look at the longer chart on the NASDAQ, again, we're actually, it outperforms so much over here this time period. We haven't even come down to the trend line or the 200-week moving average. So it's funny that a lot of these things always will fall together. This 3940 target from the flag is not far off of where the actual ascending trend line is for the Dow Jones. It's kind of in between the 200-week moving average and the trend line. So a 3950 target on the price on the NASDAQ is not something that's a wild shot. I think that's very doable, and that'll take you again back to about 2013 on that. All right, the Russell 2000, which is already in a bear market, it also has this flag pattern. So you can see it broke it on Friday and again on Monday. So you're probably looking in the 800s on the Russell 2000. I didn't bother to figure where the target was on that, as we're already, like I say, along with the Dow Jones Transportation Index, already in a bear market on the Russell 2000. Okay, I don't want to sound just put out all negatives today, because there are some things in the lining here. Now, this is the Dow Jones Transportation Index, which is also is in a bear market. However, on the long-term trend line going back to 2009, you can see that we're struggling to hold that long-term ascending trend line with the transports. The transports actually had, I believe, last Thursday, had about a 3% move in one day. So you are getting some capitulation over here on the transports. I would recommend kind of keeping an eye on this. Over in this area here, we kept saying, if we can get up to about 8,500, maybe this will prop up the whole market, and we can get the transports can help lead the way to maybe higher prices. Well, as it's led on the way down, if it breaks below this trend line, it's going to lead the rest of the market even further down. However, if we're able to bounce in here and hold, maybe the damage will be limited, and we could just put in maybe a double bottom or just get down here around 18 to 20% and begin to work our way back up. But I think you got to keep an eye on the transports and this area, because if you get down here, break below 6,500 again, that's going to be a negative for the broader market. Okay, some of the things that are supporting what we're looking at in here as far as the odds of the market going down lower. Okay, here's the New York NYSE AD advanced decline line. Again, you're in a pattern of lower highs and lower lows. If you break out the next couple of days, you break down below here, that would probably that's another. This is a leading indicator. It's going to show you that we're probably heading lower. Hey, look at the Nasdaq. You're already making new lows on the AD line here. That supports that we probably have a ways to go on that. You had a little bit of a bounce today on the Nasdaq because some of the FANG stocks have been, well, actually you're about flat on the Nasdaq, but you had a nice move in Facebook, and I think Netflix was up, and a couple of the other ones they're nibbling away at some of these FANG stocks that got crushed yesterday, and they opened sharply lower again this morning. So again, this is actually a confirmation indicator that is telling us that we're probably going a little bit lower. All right. Now, I don't want to be all doom and gloom here, but there are a couple of things that we can look at as far as where we can make some money with what's going on in here. With the dollar weakening on on the prospects of us not raising rates for a while, and then lower growth around the globe, the gold charts have actually been looking quite well. Now, this is a chart of GLD, which is the ETF that we can follow to buy and sell gold on this. Now, you've had a spike the last couple of weeks here, so you're very overbought on gold, but you have broken a descending trend line that was in place. We're in a real pretty defined channel, downward channel. But you've broken that now. You've broken above the 200-day moving average also. You gapped up, I believe, yesterday. You've pulled back today. But if you can get a chance down here around this 111, 110 area on GLD, that would, or some of the other gold plays would work fine. The gold mining stocks work. GG is one that you can look at here. I think it's Gold Core. ABX, American Barracks, has a nice looking chart. It's bottomed. It's heading higher. Even Newmont Mining, some of the other metal stocks can be bought in here. I don't really follow a lot of the smaller like Canadian gold mining stocks, but of course, if you can get a chart, take a look at those, and maybe get a second opinion. Since the second opinion is a trend following thing, you can actually pick these things up as they're starting their trend. But I would look for a little bit of a pullback. Actually, gold has pulled back a little bit today, just because from the gap yesterday. But these are stocks that you can look at to go into. I think gold has a higher price, has a higher ways to go. This actually goes back to 2011, where gold peaked up in here at let me see. Okay, this is around 125.75 or 1800 actually on this. But if you do a Fibonacci retracement down to where we recently bottomed, you can see that this GLD has a chance to make it up probably to around the 127, 128 area, where it kind of found some resistance before. That's a pretty nice trade still from down in here. Again, when you get the pullback, you can let this thing play out for a while as long as the dollar remains weak. The dollar's off again today, so right around 24.86, and we'll look at that chart in a minute. Okay, this is another ETF. It's not the actual dollar index, but it's a way that you can keep track of what the dollar is doing. This is the symbol on this is UUP. Okay, and this tracks the dollar. And as you can see, we have some support over here around 24.50, 24.60. Today we are at 24.86. Another candlestick, red candlestick coming in today. You have on the RSI, 14-day RSI, you have some negative momentum. Short-term MACD is giving a sell area. So what's going to try to happen is here. This over here was when they were starting to talk about, okay, the economy is growing. At some point, we're going to have to start raising rates. They kind of played around over here. Right over here, we started talking about we're going to definitely raise rates. You got a nice spike in the dollar. Didn't quite make it up as high as it was, but we're going over here, and again, that's going to it's going to help certain asset classes. It's going to hinder some other ones, but you want to keep, especially this 2450 area on the UUP, to see if it's going to hold that area. But that would be where I would think you'd have a little bit of a bounce or in there. Now, this is a comparison chart. You can actually do this on Smart Chart also. This is showing you how gold moves with the dollar. And what you want to know about this is this is an inverse relationship. So you can see the dollar coming down over in here, gold takes off. As the dollar starts to work its way higher, the gold spike actually rolls over. They kind of trend, sideways for a while. Then once the dollar began to move up higher here back in 2014, which caused the commodities and all to go lower, then you saw the gold pop over here. Now gold's making the move over here. The dollar's rolling over again. So this is telling you that we probably have some more upside on gold. It's broken the trend lines, and this is the commodities, especially gold, will have this inverse relationship that you want to follow. And even if you go into the ETF center on Market Edge, you can find some of the precious metals ETFs that include silver and some of the other ones. You also get some basic metals, even actually some of the soft and blended commodities will benefit from the softer dollar. Okay, next slide we're going to look at right here. This is actually a longer term trend. This goes back to 2010. I think these things kind of move. You have exaggerated moves on some of these things, but here the dollar's going down, gold's going up. It starts to come up, and you can see how little dips present buying opportunities. And when you see the dollar starting to go up, it's time to get rid of it. Over here you have another little bounce with the dollar selling off. So when the dollar comes back down like this, what's going to happen? If the commodities become cheaper for foreign countries and all, it allows those prices to go up. But sorry, I'm trying to look at some of my notes in here for this. Okay, so what happens over here with the dollar becoming cheaper? You got your commodities become cheaper for other currencies. This in turn helps also emerging markets as their currency becomes stronger. It also helps countries whose economies are heavily dependent on the commodities. And I didn't do a comparison chart, but when you're looking for someone generally asks, do I like Europe? Not particularly in here, but countries that may actually outperform going forward that are not the United States because their economies are heavily based on commodities would be something like Canada. The ETF for Canada is EWC. Australia is another country that you might look for a bottoming process. EWA, even some of the emerging markets, EMM is the emerging market, but EZA is South Africa. The economy is almost purely on commodities. Mexico is another one. I don't particularly like it, but even Russia, RSX, is an ETF that the dollar keeps heading lower. Russia's market is really oversold right in here, especially because of oil and stuff too. But some of those emerging markets would be ones that you could probably get a little bit of a trade in. I don't really, I'm not really wild about just picking up any of those right now. It's kind of a contrarian buy signal to me right at this point because there's still so much weakness. But I think I'm looking for my E. Okay, I don't have it on here. I had EEM on here as one of the emerging markets, and it was also, I just had some notes on the chart. EEM, which is the emerging market ETF, is so oversold. I was reading this week that it's priced to, the current price to cash flow right now, it's in its 97th percentile. I mean, the EEM has only traded a lower multiple, 3% of its history, going back several years. So, and I think price to book is in the 99% thing. So even though it's a contrarian trade right now, some of these emerging markets are so oversold, trading at levels that you've probably never seen in your lifetime. It may be good to start looking at some of those ETFs either as a group or maybe some individual countries that can benefit from the weaker dollar, and it might be a chance for you to get something dirt cheap. Okay. Before I start looking at some of the different sectors, because I'm going too long again, I wanted to point out that some of this analysis, it's called intermarket analysis, that you may want to watch. And what it does, what you're trying to point out, and if you don't get anything else from this whole webinar today, what we're talking about is how classes should work together, asset classes, and not how they always will. So they don't always act like it. There's always other components that come into play that will, screw up oil or screws up the dollar or some kind of something, or banking financial crisis or something. But what's important is that you know when they're working together and when they're not. So in other words, when the dollar comes back, gold should be moving higher. That's how you'll make money on these intermarket analysis moves. So you look back and you change the dollar and say this should happen. If you see it working, then you can act. And because these trends are not usually short-term pops, they can play out over 6 months to a year. It'll allow you to get into these trades, see that it's working. This is the way it should work, and you can work with the trade that way. And also, it'll show you that when it's not working, and occasionally you'll come up with some scenarios where, okay, this should be happening, but it's not. So you stay out of the trade until you see it actually working, and that'll save yourself some grief, and it'll allow you to make some money on some of these counter trends. All right. Now, what else in the stock market works better with a weaker dollar? You're seeing it over the last couple of weeks. One of the sectors that's already in a bear market is the materials sector, which is comprised mostly of a lot of commodities, lumber and everything else, copper and all that. If you're looking at the materials sector right now, the commodity, this thing has gone up, has found support from a bear market. You've had a nice bounce. As this thing's going down, this thing's starting to go up. I believe that if you're looking for some oversold stocks, as long as the dollar stays weakening, especially if it breaks through the 24.50, you may want to either go into some of these ETFs, commodity ETFs, or some of these the gold mining stocks, or just you can go into XLB and find some of the biggest stocks that make up those sectors and some of the different industries. Another sector that you want to watch with a weaker dollar is the energy sector. Now, this one is a little bit funny because as the dollar goes down, oil should go up. So this is one that we talked about. This is what should happen, and make sure you can see the correlation, even if it's an inverse correlation. Now, if oil breaks down here again below this 26 or 27 area that we had targeted before, which I think it's going to test again, then even despite the weaker dollar, then maybe you will see the oil spike lower. However, I think that if the dollar can come down here and kind of just trade sideways to slightly down, then maybe we can help stabilize the oil prices, and that could help the energy prices. We talked last week about some of the different stocks that you might want to buy in the oil companies. Again, just look at the balance sheet, and we had a lot of stocks that actually had a nice pop over this last week. Some of them were up 6 and 7%. So again, the energy sector can improve in here if the dollar stays weak, but the crude oil, you got to make sure that still is working, because if it just cracks, it's not because the dollar's too weak. It's because there's just too much supply, and demand isn't there from the slowdown in the emerging markets. Like another sector that I haven't particularly liked was the industrial sector. The industrial sector will also can benefit from a weaker dollar, mainly because when they pick up their revenues from overseas, you have that currency risk when you bring it back, and the dollar's strong. It can tap off anywhere from 8 to 12% or more of your earnings off of the revenue. So you might start to look at some of these industrial stocks, especially that have are overseas. Even some of the big high tech stocks like Intel, they get a lot of revenues from overseas, can come into play in this with the weaker dollar. But here's You can see you're bouncing off this 200-day moving average on the industrials. You want to watch to make sure that holds. If it holds, it starts to work higher. And some of these other ones like Lockheed Martin, United Technologies, some of these might be a chance for you to bid them a little bit higher. Okay, of course, we've been talking a little bit about the utilities last week especially, and we certainly got the pop that we were looking for, even more than what I thought we were going to do. We've talked about a lot of different stocks in the Market Edge Industry Group analysis. Gas companies, electric companies, water companies were the three top industries. In fact, on the 50-day RSI, I believe on like electric, it's 1.21, which means the electric companies are outperforming the S&P 500 by 20% over the last 50 days. So I think these are very overextended right in the short term, but utilities probably have a little bit more work to do as the market rolls over. So don't chase them, but you do want to have some extra exposure. Okay, I'm going to try to wrap this up, but I did have a couple questions. Someone asked about American Electric Power. Again, you're in the right sector, you're in the right industry. It's a great looking chart. It's bounced off the trend line going back to about 2011. Over here, you bounced off of that. Relative strength of 1.21. Buy on a pullback, but American Electric looks good in here. Another one, someone wanted to ask me about PEG, P-E-G. This is the Public Service Enterprise Group. I don't like this chart as much. It had a heck of a bounce off of this, to start the year, 37 to 47, 25% spike in that. But I think this is a diversified energy company. I believe they're out of New Jersey, that area. But they got exposure to coal, a couple other things. Nice dividend. Just overbought in here. You might wait to see this thing pull back to around the 40 area. Okay, last one before we open up to questions if you want to start typing. This is Southern Company. This is down in our neck of the woods. This looks good. We're at about a 4.5% dividend, which looks safe. They also have a nice nuclear presence down around Savannah, and they're helping to build some other nuclear power plants. So I think this did actually pull back last week and bounced back again. Any kind of pullback on Southern Company, I think it's a good stock to own, especially longer term. With that dividend, you're probably going to see it, downside risk somewhat limited. Okay, with that, I'm going to try to open it up to questions in here. Not sure if we got any. Okay, Tesla. Let's look at that. I'm going to turn off this screen here, and we can look at I can share it with the charts. New version, no. All right, TSLA for Tesla. Let me get rid of some of my stuff in here. Let's just go out and look at over the 1 year. Not much to like in Tesla on this. You're falling out of bed. You're very oversold. You have some work to do on Tesla before you want to go into this thing. In fact, you have support down here around this 120 area. Not sure what it's doing today, but other than that, you've got some. That's about the only support you have on this is around 120. What the longer term picture is, I don't know, but they're throwing this out, the high momentum stocks out with the bathwater over here, and I think that I'd be very cautious, especially if the broader market keeps going lower. You probably don't want to own Tesla at this point. You want to you want to wait until the broader market reverses course, and then you can start looking at some of these high tech stocks again. So it looks like it will keep breaking down. To me, I don't see anything that's you don't have any support in this thing till at least 120. And again, if the broader market's weak, this is going to pull this down with it. I don't know what the PE is on this thing, but I know it's got to be astronomical. So you're buying this thing, catching a falling knife at this point until the broader market starts to stabilize. You're not going to get anything. You don't want to buy it yet. You're going to have some bounces on it, but don't buy it here. If we have another one coming in here, are these recordings available? Yeah, I sell them for $20 a piece. You can just send me an email. Now, if you go into you go into Market Edge and go into on the Markets tab, at the top of the page it'll say click here for this week's recording. It should be up today at about probably about half an hour or so, and you can actually go back on they go on YouTube. You can go back a couple weeks and see them in there. Okay, last call for questions. Okay, I'm glad you could join this. I hope you got something out of it. Again, we're kind of at a crossroads with this market. This flag pattern makes me a little bit nervous. I think we are getting oversold again on the broader averages, and I think I'm still looking for a little bit of a counter trend bounce, which whether we get it or not, I'm not sure. But hey, just be careful with this flag pattern. Next week, I want to try to go into looking at some of like the VIX and some of the volatility indexes for oil and for some of the different indexes that you might be able to get some protection for your portfolio if we do have another spike down. Yesterday's daily commentary, I told you that the NASDAQ is down 19.5% from its high back in July. You have several indexes already in bear markets, so we want to keep an eye on this thing. If we do start to break below about 15.8 or so on the Dow, it could intensify the selling pressure. So let's see what happens. Maybe Janet Yellen can get us to go sideways for a little bit, or at least spark a counter trend rally. And I hope to see you all next week. Thanks for joining me.